This past Friday, copper soared over 7.5%, and even oil had its own little party up 5%. So what happened? Well, you wouldn't be faulted for thinking there were some rumblings of the long-awaited Fed pivot, especially in light of the substantial weakness in the US dollar. But really, it had everything to do with something else. Something far from US soil, in fact. Unconfirmed rumors that China is warming up to the idea of easing its COVID-0 policies. Was Friday the warning shot of a renewed bout of commodity strength? And if so, what might that mean for the Fed's battle with inflation? That's this week's big conversation. The reason Friday's action should be on all of our radars is really quite simple. Over the past several months, commodities have eased off the torrid pace they began the year with. In many people's opinion, it's been the ongoing monetary tightening starting to play its part in the Fed's objective of softening economic demand. And yes, the pullback in commodity prices has helped to ease some of the inflationary pressures the world was facing earlier in 2022. But if China's potential reopening is as bullish for commodities as the market has suggested over the past few days, then there's a very real risk that the infamous Fed pivot has been delayed. Let's be crystal clear though. The rumors that had the market so excited on Friday were just that. Rumors. In fact, Chinese health officials held a press conference this past weekend to address their targeted COVID prevention policies. According to one National Health Commission official, China's practice has worked. They've apparently proven that their pandemic prevention and control strategy is the correct one, and as such, their measures are proven to be the most economical and effective. So much for ending those COVID lockdowns. To be fair, buying too much into unconfirmed social media posts carries its own risk, but the constant back and forth on this topic is enough to make anyone's head spin. Now, come Monday morning, various news outlets reported that China was indeed weighing a gradual exit from its zero COVID policy. They stated that it expects to proceed with caution and without a fixed time frame. But instead of racking our brains about whether or not China will actually abandon their current COVID strategy, it's helpful to simply think through the ramifications so we can be better positioned for the ultimate outcome. So let's go back to the commodity complex. There are some beliefs that China's zero COVID policy has contributed to the softening in oil prices as a result of reduced Chinese demand. Same could be said for copper. Well, that and the significant deleveraging that we've seen play out through stress in major developers such as Evergrande over the past year. But what if both of those forces are about to reverse course? According to recent data released by the People's Bank of China, the broad money supply, as measured by M2, climbed 12.1% on a year-over-year basis as of the end of September. So yes, Chinese policymakers appear to be back with fiscal support, which should lend support to industrial commodities. On the other side of that coin, though, there are deflationary aspects to consider as well. For starters, easing measures at a time when the rest of the world is still engaged in monetary tightening could bring about weakness in the Chinese yuan. A weaker yuan is broadly thought to be deflationary for the rest of the world in the sense that other countries are now importing cheaper goods. And then there's these supply chain issues, which are still all too real, as evidenced by Apple's recent announcement that COVID restrictions in China has led to significantly reduced capacity and thus slowing shipments of its iPhone. If you remember, reduced capacity across manufacturers and port operators was largely pointed at as the root cause for major shipping bottlenecks, which ultimately translated into a surge in shipping costs in 2021. Again, if we are to believe that China will slowly emerge from drastic lockdown measures, that's another feather in the cap of those hoping for smoother operations within the global shipping complex. So, basically, which one will it be? Will China's potential reopening create additional inflationary pressures, or could the deflationary aspects be enough to offset those concerns? Well, that's the looming question that will require further investigation. The Fed has already performed a significant amount of monetary tightening, and as Jerome Powell always reminds us, their measures act with long and variable lags. The real answer is likely to be far more nuanced than just one overarching implication. And take, for example, the shipping sector. If US demand is slowing while supply chain bottlenecks are set to ease with China's exit from zero COVID, then we could be looking at a difficult environment for shipping stocks, which have enjoyed an enormous boom over the past 2 years. On the other hand, global material stocks could be facing another demand surge due to China's increased fiscal support. All in all, if you are in the firm camp that the Fed pivots soon, then this episode should give you reason to pause and think. The recent developments in China, or should I say rumors of developments, could muddy the picture for an already uncertain outlook. While the deflationary aspects might be enough to offset the renewed inflationary pressures, the Fed may not need to do a whole lot more. But maybe it's an argument that rates will simply need to stay higher for longer. And if rates do indeed stay higher for longer, well, investors might actually need to dust off those old fundamental analysis textbooks after all. Now, I know a lot of US investors have been keeping an eye on the UK more recently, given the fast-changing government and big swings in cable. So to discuss more about what changing governments could mean here in the US, especially given the midterms, and what the recent rise in commodity prices could mean for the UK and Europe, I sat down with Brian Hilliard, Chief UK Economist at Societe Generale. Dr. Brian Hilliard, welcome to The Chatter.
Thank you very much. I'm pleased to be here.
So, Brian, we have been talking quite a bit this week about what happened on Friday, which was really a big move up in a lot of commodities prices. It was fueled by rumors of China essentially relaxing their COVID policies and perhaps seeing Chinese demand back once again. And the reason we found it such an interesting topic was because it may reignite the inflation story once again, give another leg up to the inflation story. Now, in the US, where I am, it feels like Jerome Powell has a little bit more room to keep hiking, given the labor market is pretty tight. But if you could just give us a little synopsis of what the inflation story is now in the UK, what you think is going through the minds of the BOE and kind of your outlook for inflation within the UK right now.
Well, the UK inflation environment is completely idiosyncratic. And the reason for that is that we have a utilities regulator that until recently has been setting a price cap based on energy price futures of the highest marginal cost producer, which is gas. And that meant that we've already seen increases of 54% in April. The next one, if it had gone through in October, well, the one that did go through was 25%, even with some kind of price guarantee, and unregulated it would have gone maybe 80% or higher, and then in April next year would go up again. So it's very much tied in with this specific sort of lags that the regulator imposes by resetting this price cap every 6 months. The politics are very messy because the brief reign of Liz Truss as Prime Minister, she put in place an energy price guarantee which would have lasted 2 years, and that would have meant pretty certainly that the peak in inflation was a little below 11% now. Rishi Sunak has taken over. He's pared back that energy price guarantee to 6 months and then is going to have a review. And I think that review will end up maybe rolling over the price guarantee for another 6 months, but no longer, and targeting it in terms of benefit payments to those who are most needy. So that means you will see more of a plateau, I think, in inflation rather than a rapid fall. But it still could be, 6-7% by the end of next year, and then coming down more rapidly after that. In terms of monetary policy, things are getting very, very complicated. The Bank of England clearly is very worried about domestically generated inflation. It accepts that maybe 70-80% of inflation is outside their control through commodity prices. So that point you're making about China has a great bearing on that as well. But they're trying to control inflation expectations, which are complicated by these strange energy effects. But they condition their forecasts on what the money market believes interest rates are going to go to. And I'll explain that carefully because it is quite messy. We had in the latest update of the forecast last week, conditioned on market profile that rates would peak maybe 5.25%. Now, the Bank of England went out of its way to say, well, no, we've got to use some kind of conditioning assumption, but we don't think rates are going to get anywhere near that. But if we can be even more specific, they produced two sets of forecasts, one based on that market rate profile, and that takes inflation down to 0 in 3 years' time. And even on unchanged rates of 3%, it takes inflation to 0.8 with a massive output gap opening up. So, the valid question one can ask is, why are you raising rates at all from here? Why are you giving that signal, as indeed they still are? And the answer is that they have got themselves in a bit of a mess. I think what it tells us at the very least is that in conjunction with this forecast of an extended recession, which would be 8 quarters on their market profile assumption, that there's very little need to raise rates much further. I mean, my forecast is that they go up maybe another 1.5% to 4.5%, but the risk is balanced at best and possibly more to the downside from that peak now.
So if I may ask you, Brian, about a month ago or however long it was when previous Prime Minister Liz Truss, still amazing to say that, came out with her economic plan and the sterling started tumbling and the BOE didn't decide to do an emergency rate hike. Instead, they went and bought gilts. Was that a sign to you at all that the Bank of England is less interested in raising rates and perhaps more interested in seeing if a recession will naturally bring down inflation and therefore there's no real need to raise rates?
I think it's not quite that straightforward. I think that we should interpret that purchase of gilts as QE. So it is a temporary easing of policy, but it was addressing a financial stability risk when the pension funds got themselves in a bit of a mess with their LDI strategies. But since then, they've actually set up this active gilt sales, so quantitative tightening. So they are on a tightening path still, but I think the financial instability that they stepped in to correct does at least point to a very cautious approach to any more tightening. And yes, they do know a recession is coming. They think it's going to be pretty extended. So, I think we can't believe that they're going to be acting aggressively.
And I'm guessing Mr. Sunak is going to have to find a way of paying for this, for these energy relief packages. Where do you see an increase in tax coming from?
Well, I mean, he's going to do it in a way he's done it already, which is a stealth increase by not increasing nominal income tax allowances. And when we look at the previous set of forecasts on public finances from the official fiscal watchdog, we were reaching tax to GDP ratios that were, 40, 50-year highs because of that stealth increase through income tax allowances being frozen. They will do more of that. They will extend those income taxes, those allowances in nominal terms at the same level for more years. They've also said that they're not going to go ahead with this planned cut in income tax from 20 to 19%. And that was when Rishi Sunak was previously Chancellor. So, they're going to do that. I think windfall taxes of some kind will be extended. There is a debate about extending the energy windfall taxes and maybe changing the taxation regime of banks a little bit. So those are the ways they do that. And the other side of the coin, of course, is spending cuts. And, let's say roughly they're going to do 50-50 tax cuts and tax increases, spending cuts. Spending cuts are very, very difficult to do. We've had an extended period of austerity in the Cameron-Osborne years, and that's really cut down to the bone, especially when you consider that the UK government sets its spending plans in nominal terms. So, inflation is really, has meant that there's very deep real cuts. So they can't do that over the existing planning horizon. They've got to load any fresh spending cuts into the back years of the forecast, maybe out to 25, 26, 27, which guess what comes after an election. But, the public aren't fooled. And I think an important sort of political point to make is that although the new Sunak administration has allowed a return to stability, it doesn't get a return to popularity. The Labour opposition party is well ahead in the polls. So I think whilst one is looking very short term at sort of policy stories, one has to have one eye on 2 years ahead to what the Labour Party may want to do.
I want to ask you about housing, if I can, Brian. I'm wondering if housing is a more sensitive issue in the UK than is in the US. I think I'm right in saying a higher percentage of mortgages in the UK are on floating rate versus over here in the US. And how much does that factor into what the BOE decides to do next?
I don't know the precise numbers comparing the two countries, but we've seen already that fixed rate mortgages, which are an increasingly important part in the UK, people have been trying to reset those fixed rate mortgages, and they've found, because of the massive increase in gilt yields, partly because of the global trend, but also because of what you might call the truss risk premium, the resetting of those fixed rate mortgages is at much, much higher levels. And what that's going to do, I think, is push a housing market that was already overdue for a correction into a downturn. And we've seen two of the most closely watched house price indices, the Halifax and the Nationwide, show pretty sudden monthly downturns in the latest data. So the housing market is going to weaken.
Do you make any kind of forecast about what kind of weakening we could see?
No, I don't give a specific number, but I think that the house price inflation, sort of because of some anomalies, peaked at 15%. Is going to come down well into single figures, I'm sure. I think the housing transactions, housing volumes are more the issue. So the housing market is going to slow down materially. I think that's the big point.
And I wanted to ask you, I know there'll be a lot of people in the US watching this. Do you have a view on cable? Obviously, we've had some pretty material moves over the past couple of months. Do you have an outlook for cable? And I guess there'll be people wondering whether they should be spending Christmas in New York or London.
Well, I would defer to our FX strategies, but the basic point is that we've become obsessed with expressing the sort of confidence of financial markets in the UK by looking at sterling against cable, the cable in particular. But it's more a dollar phenomenon than it is a UK sterling phenomenon. Dollar is tremendously strong against everybody. Sterling has weakened on that. We should have a period of stability now, but it's about relative rate expectations. If people are looking for a peak forming in Fed rates, maybe a little earlier than otherwise would have been the case, and the UK is still raising rates, and that's going to provide some sort of stability, maybe a sort of a modest upside to cable.
And Brian, finally, just to ask you about employment, how do you see the unemployment level looking over the next, say, 6 to 12 months in the UK?
I think it's going to rise steadily but gradually. We have a strange situation here where we've had the unemployment rate at multi-decade lows, even though we know that employment growth is weakening. And what is happening is that the level of inactivity is rising. And that's because there are more long-term sick, partly because they didn't get treated properly during the pandemic for obvious sort of lack of contact reasons, if you like, and also long COVID itself, and also people in the 55 plus age group moving into retirement. Maybe pandemic was a sort of lockdown was a dry run for it, if you like. So all those things are sort of presenting a slightly strange picture in the unemployment rate, but I think that the rate is going to rise, and I think employment is certainly weakening. We've seen the top in employment growth, and it's on its way down, and we may actually start to see some falls in employment.
It does feel like employment data has been somewhat skewed over the past 2 years, and it's actually quite difficult to get an accurate reading, whether it's over here in the US or in the UK.
Yes, indeed. And the complicating factor in the UK is we have two sets of data. One, which is what you might call the definitive labour force survey data, which is covers a 3-month period, but is not very timely. And then a new set of data, which is payroll data. And that sometimes paints a slightly better picture, a stronger picture. And the way of squaring that circle is to observe that the labour force survey includes the self-employed. Payroll employment has got back to pre-pandemic levels, but self-employment has not. And I think with the recession probably having started already, self-employment has peaked already. So that's going to take the shine off the numbers. It's a very sensitive indicator to weakness in general activity.
Well, Dr. Brian Hilliard, Chief UK Economist at Soc Gen, I want to say thank you so much for your time. I know you're a busy man, and once again, thanks for joining us.
Thank you very much. It's been a pleasure.